Thank you very much for inviting me to this seminar. As the professor has indicated, I'm CEO of Tendercapital. Tendercapital is an asset management company based in London. We do a series of projects. Within the projects, we also have an area in private equity. In private equity, we do investments in renewable energy projects. So we do investments in sustainable energy and also infrastructure. What we're about to show you is the result of many months of organization, projects, and plans with 20, 30 people across Europe. And this involved the organization of our new umbrellas for the private equity funds, which we have created. So you're seeing a summary of knowledge from this process over the past 6-7 months. After my presentation, Mr. Paradi will take care of a concrete example of investments and the type of investments which go into these funds. I'm here to present the financial structure, so it's a financial structuring lesson which I believe will be useful for yourselves in terms of understanding which vehicles are important for the creation and for the marketing of such structures on a worldwide basis. So in summary, I'll be talking to you about the vehicles on a UCITS and non-UCITS basis, and I'll go into more detail in terms of what they actually mean. We will be focusing our interest on non-UCITS, because in the non-UCITS space we have the alternative fund structures. Within the alternative fund structures we will have the indications of those structures useful for investing in sustainable energy projects. We will speak very briefly in terms of the jurisdictions that we will be looking at. I mean, the classic demarcation is between onshore and offshore. We will not go into the offshore basis. We'll be focusing on 2 countries in specific. We'll be focusing on Luxembourg and in Ireland. It is very possible, and it's also very common to do offshore structures. When we look at offshore, we're looking at structures, for example, based in the Cayman Islands or the BVI's, or even Malta at a certain point was considered offshore for a while. Now it's an onshore jurisdiction. I would like to focus your interest on Luxembourg and Ireland because those are the 2 biggest onshore jurisdictions currently in Europe. We will look at the regulatory status of the UCITS and the non-UCITS in terms of the directives which are coming on board. We will talk about the legal entities which can be used to create the sort of structures and funds that we will be looking at. We will be analyzing 2 fund structures in particular, the QIF structure and the SIF structure. QIF structure, we're talking about the Irish fund structure for alternative investments. The SIF structure is the Luxembourg. And we'll be talking very specifically about the QIFs, so you'll have a case study on the QIF. I will also illustrate a few points regarding the organization of a fund, so you have basically a 360-degree view on the service providers and the people who play a part in terms of managing the fund once it's set up. And I'll also speak about the recent European directive, the Alternative Investment Management Fund directive, which will be active in July this year. So it's quite recent, and I will discuss what you need to know in terms of setting up a fund and what it entails to follow this sort of directive. So that's the summary of the lesson. So if we proceed, I don't know, please, if you have any questions, don't hesitate to interrupt me. I think you all have some sort of knowledge in terms of these sort of structures, so I'll try to go into a bit detailed explanation if you need so. So UCITS, as I said before, we won't be concentrating too much on these because these are the regulated onshore structures which are used for common trading. So for equity funds, for bond funds, they have daily liquidity, they're very, very regulated. There are undertakings for collective investment in transferable securities. I don't expect you guys to remember the name, just use the acronym UCITS. It's very easy to remember. It originally started with the law of the 85, the UCITS 1. The current law is the UCITS 4, which became active in July 2011. in the main European countries. Italy, for some reason, was late into the game. They approved the directive in July 2012, so a little bit later compared to the others. The main reason for the creation of the UCITS was to create a regulated, harmonized regime for all open-ended funds, and that meant that they brought a series of rules, regulations, and limits to the activity, to the objectives, and to the investment strategies which could be into the funds. So they're very restrictive, and this was to protect individual investors in the fund. So people who invest in these UCITS funds can be authorized, the creators of the funds can be authorized to market these funds to retail investors. So to private people like yourselves and myself, we can invest in these funds, which is, as we will see, totally opposite when we look at alternative funds. Because the kind of investment objectives and strategies which are used in private equity, also sustainable energy, are not daily liquidity funds. There are funds which are active for many years, because you can go from project analysis to development to construction to the sale of electricity on the grid, and therefore it takes years for these things to develop. They are not investments for the private retail, they're investments for qualified investors. We'll go into the definitions and so forth. As I mentioned before, in the bags that we provided to you, you'll have a USB key. Within the USB key, there will be this presentation, so you can have it and you can look at it after we finish. Now, going into the non-UCITS universe, which is a universe which is of more interest to you, you can see that these are the various strategies which can be employed within the non-UCITS space. So we're looking at hedge fund strategies, private equity strategies, VCFs, and real estate funds. I mean, it's not limited to these sort of strategies, but just to show you that it's very flexible. That means there's less regulation. That means there's less limits when you have these sort of funds. So the advantages are quite a few. It's very flexible, so you can decide effectively what strategy you wish to adopt, what your objectives are. No restrictions, less regulation. Less regulation means that there's strict rules for the distribution of these funds. So you have to follow very strict rules in Europe in terms of who you can market these funds to. These are funds where you'll not find them on the papers. You'll not find them marked in terms of prices, sales, and so forth, because there's one target, and the target is an institutional target, or sophisticated investors, not for the retail. So therefore it's quite limited in terms of its scope, in terms of publicity, in terms of marketing, but once it's active you can go worldwide and go into the big investors to have the investments coming in. What is key in all of this is the prospectus. I mean, I'm not a lawyer by profession, but when you do this sort of activity in terms of financial structuring, you have to be aware in terms of what the rules and regulations are. The prospectus is an ideal part, is a fundamental part of the entire equation. What is written in the prospectus, it illustrates exactly what the fund is doing and what it wishes to do. Anything that goes beyond that scope will be slammed down by the regulator. Therefore, it's quite important to leave. You'll see that prospectus for these sort of funds can be quite complex, can be quite complicated, can quite completely very detailed, because they want to cover all the risks for people investing in those sort of funds. And that's very important. You have prospectus which can be 100 pages long to do sustainable energy investments, because they go through the entire process to ensure that there's no legal implications for the investors that come into it. And part of this universe, and we'll see more in detail, are the QIFs and the SIPs. As I mentioned before, the QIFs for the Irish market and the SIPs for the Luxembourg market. So let's have a look at this market just to give you an understanding of the size that we're looking at. This is achieved from the IFAMA source, which I can give you the website if you wish. These are the assets under management in Europe, in the investment fund universe. So this is the UCITS and the non-UCITS. Currently at the moment in Europe we have over 9 trillion euros in investment funds. 9 trillion euros, of which around 6 trillion are in the UCITS and about 2.5 trillion are in the non-UCITS. So it gives you a big size only in Europe in terms of what's involved. Now of course the UCITS are bigger because they're more directed to retail, and so there's a bigger market there. But that doesn't mean that the non-UCITS market is smaller, because 2 trillion euros in Europe is actually a very big size. And you can see the natural progression over the years, how the UCITS developed in the 90s and the late 90s from 3 trillion, they've doubled into, this was 2.3 trillion, it's now become 6 trillion. And the non-users, which were 0.6 trillion, are now at nearly the 3 trillion level. So there's been a huge growth of these instruments coming across. And this is also due to the fact that we've had a huge movement from offshore regulation to onshore regulation. Because effectively, even the non-users are now being regulated. They're onshore entities. They're a lot more transparent. And this transparency has meant more investments in these sort of funds. Okay. I want to take a step back and mention the fact in terms of the legal entities we talked about. If you go offshore or if you invest in these sort of projects, you're aware that you'll usually be investing in SPVs and local companies and so forth. That's one sort of structure that you can use. The fund buys those sort of structures. So there's two steps there. There's the project, there's the SPV, and then there's the fund. I'll go more into detail in terms of how that works. This is just to give you an idea in terms of the size. I've chosen Luxembourg and Ireland because you can see better here from the numbers. Luxembourg has a total of 2.5 trillion of funds, of which in the UCITS it's about 2 trillion, the non-UCITS is 0.4 trillion. Ireland has 1.3 trillion total. As you can see, the non-UCITS represent 300 billion euros worth of funds. If you actually look at the data, you'll see France is in between Luxembourg and Ireland, and that's due to a very specific case where France has a huge amount of pension funds. And the pension funds are a huge market, and and the number you'll see in terms of total, I think, is around 1.7 trillion. A lot of it is UCITS, and that's why, but I haven't put in France because it's not interesting for us to look at the structures. And the data, as I said before, is from FAMA, from the European Fund and Asset Management Association. It's online. They do reports every 3 months, so you can see the development, you can see everything happening as it occurs. Let's look at the legal entities. As I said, I'm not a lawyer by profession, but these are important things for you guys to understand when you try to set up companies, which then become funds or become umbrella for the funds underneath, for the structures underneath. If you look at Luxembourg, they have 3 main structures. They have the FCP, which is the Fonds Commun de Placement, which is a common fund, does not have any legal personality, very commonly used for the setup of legal entities. For the non-UCITS, they tend to use the CCAV, which is the Société d'Investissement Capital Variable, so it's variable capital, so it's not a fixed capital base, so you have a social capital or initial capital, which will start maybe between 100 and 200,000 euros, which can increase to 1 million or 10 million, so that's why it's called a variable capital. This is a structure which is very commonly used in Luxembourg, and we'll see in Ireland as well, and that's due to the fact that you can start with an initial capital. After the initial money comes into the fund, that capital can be pulled back and be substituted by people who invested in the fund itself. You have the CCAV, which is Société d'Investissement Capital Fixe, which, as it says by the name, is for fixed initial capital, which remains that capital for the life of the company itself. In Ireland, we have slightly different legal entities because Ireland is very more Anglo-Saxon in terms of derivation. So you have a couple of indications coming from the UK and also from the US. They have various structures that you can use. You have a unit trust. The unit trust means that there's a trust deed between the trustee and the manager. Does not have any legal personality. I can go into more detail later if that's of interest. Then we have the variable capital company, which is an investment company with limited liability, which is one which is more commonly used in terms of Ireland. It is similar to the CCAF. So you can already start seeing similarities in terms of the legal. The investment limited partnership, where you have one general partner, the others are limited partners. This is a private equity structure that you'll find very much in the US. It's very much used in the US. They have one general partner who has all the risk. Then you have all the other limited partners coming in as partners, and they have a split of the profits, but their risk is limited. So for them, it's a very, very useful structure for them to have. The whole risk is based on the one general partner. You'll find that the general partners are bigger firms with bigger balance sheets. But it's a very tax-efficient structure which is used in the US. It's not used very much in Europe because they do well with the variable company. And the other one is a common contractual fund. This is a very specific legal entity which is created for the pension funds in Ireland to pool assets. It's not something which I think will be of your sphere of interest because it was something specifically made for them. But just so you're aware, there's about 4 structures in Ireland which will be used. We'll be focusing on, in Luxembourg, when we talk about SIFs, it will be on CCAF basis. When we look at Ireland, we'll probably be talking about the variable capital company and the unit trust. So those are the ones that you should be focusing on in the future. Non-UCITS. So if we go into Luxembourg, I mentioned the SIF. The SIF is and refers to the Specialized Investment Fund. And when they talk about Specialized Investment Fund, they're talking about what they call well-informed investors. So investors in the fund have to be well-informed. To be well-informed means that they have to be either institutional investors or professional investors. They can be self-certified, but that means that they need to invest a minimum of 125,000 euros. So that's the minimum invested in these sort of funds. To give you an idea, when you look at the UCITS funds, minimum investment can be €1. So there's a big difference here. The regulator wants to ensure that who invests in these vehicles has a certain level of sophistication, and therefore they raise the initial limits. And you cannot remove those. Those initial limits remain. They are not, however, enforced for successive investments from the same client. So when the client invests at the beginning 150,000 euros and then comes in a year later with 50,000 in the same fund, that can be accepted. The important point is the minimum investment for the first investment has a target of 125,000. On top of that, you'll understand better when you go into the investment banking universe. There's a whole due diligence process which is done on the investor. For the due diligence process, you can also go through a bank certification where the investor himself certifies that he's a well-informed investor. So he replies to a series of questions. He replies to the fact that he's a professional investor. He replies to the fact that he has monies available above a certain amount, and that he will invest minimum 125,000 euros, that he has 10 years of experience in the financial markets. With this self-certification, we can also say that he's a well-informed investor, especially when you're looking at high net worth individuals. High net worth individuals are not institutions, they're individual people, but they are sometimes highly sophisticated. And there we go through the bank certification or self-certification, which is quite important because a lot of these products, especially over the past 10, 15 years, the building base were high net worth individuals. Then it moved into family offices, institutions, insurance companies, pension funds, and so forth. Eligible assets, as we mentioned before, since we're talking about non-UCITS, we're talking about alternative structures, there's no limits. No limits to what you can invest in, no limits in terms of leverage, no limits in terms of borrowing. What is important, however, is you have to have a very accurate risk management system, which I think is very specific to the course that you've done over the past months. It's a key. It's a key for all the funds, UCITS and non-UCITS, to have adequate risk controls of the investments within the portfolio, because you will be responding directly to regulators, to investors, if risk management procedures have not been followed. I can't insist more on the importance in terms of risk management systems. On top of SIP, there are the other two structures that you can use. There's a CCAR. The CCAR, however, is very specifically referred to risk capital. When we talk about risk capital, we talk more in terms of pre-IPO financing. So companies which are ready to be quoted on the market or will be going to the market in 2 or 3 years' time usually have the issuance of convertible bonds behind this. You have mezzanine financing, so it's not very much into your area, but just so you're aware that this is another alternative structure that they use for risk capital. There was a situation that I had in the past of a possible flotation of a company in Spain. That was based on a CCAR structure to begin with, which was then going to be transformed into a quoted company. So it is used, and that was for alternative investments as well. So according to the case that you use, it could be used, but it's very specifically directed towards pre-IPO and IPOs. The UCI is an undertaking for collective investment. It's an invention from Luxembourg. As I call it here, it's an almost UCITS. They wanted to create a fund which replicated the UCITS regulation, but this hasn't been received on a uniform basis by the European countries. So if they wish to market this fund in Europe, they need to go to every single regulator to get permission to market. Up to now, from my understanding, the regulators have always insisted that this is a fund which can be only done on a private placement basis. So it won't be part of the harmonized rules that we'll see in the future regarding the Alternative Investment Fund Management Directive. This is Luxembourg. If we move into Ireland now, as you can see, we'll be focusing mainly on the QIF, which will be our case study today. So the QIF is a qualifying investor fund. So we'll be looking at the eligible investments, which you probably already know what they are, the investors, the segregation of assets when we're looking at an umbrella structure, the diversification. Now, the QIF in Ireland is a bit peculiar because all the legislation derives from the Companies Act in 1990. So there is not a specific Securities Act for the creation of the QIF. It's all based on company. What I mean by Company Act, just to give you an example, you want to create your own company because you want to launch a retail outlet, a bar, a car sales. It's all part of the same law and legislation, Companies Act. What I can tell you is that it's been delayed, but we have a new ICAV which will be coming up. The ICAV is basically a copy of the Luxembourg CCAV. What they will put in is securities regulations specifically for funds. They've been held up because they have the AIFMD, which is now coming into force in July. But this means that it'll be moving from Companies Act into a securities law, which makes it much easier, much more transparent, much more fluid. And I'll explain why, for one specific reason, why it's going to be important. Let's move into the case studies. The qualifying investor fund. Here I'm going to go into a little bit more detail in terms of what it means to set up the fund and what the fund can do, because we're talking about fund structures here. So eligible investments, everything. Whatever you can think of, you can use a QIF to do. And this is sustainable energy, this is infrastructure, hedge fund strategies, long shorts, systematic trading. It can all be put in the QIF. There is a limit here that you can invest in other unregulated schemes with a maximum of 50% in one scheme. There's this limit because they don't want you to create a fund-to-fund structure. There's other structures that you can use to do fund-to-funds or master feeders, which we won't go into. They want to avoid that. They want to avoid you setting up a structure on the QIF basis and then you're investing into other funds. For that, there's other structures which are cheaper, more transparent that you can use. The QIF structure is used mainly to do investments. Investments, for example, in alternative energy projects, sustainable energy projects. And the investors, we already talked about them in Luxembourg, very similar here for Ireland. So they have to be qualified investors, professional, institutional, verified, self-certificated. It's the same process for Luxembourg, it's the same process for Ireland. With a small difference, in Ireland the level of minimum investment is slightly lower. It's 100,000 euros, not 125,000. They still haven't harmonized that. I expect them to harmonize that maybe in the UCITS 5 or the UCITS 6, which is upcoming. But the minimum investment is 100,000 euros for these sort of investments. It can be set up as a single fund or an umbrella QIF. And then you'll see on a graph that I have what it means to have this set up. If you set up an umbrella QIF, it's basically, as the term illustrates, it's an umbrella. Beneath the umbrella you have the single sub-funds. And it's important legally because there you have a segregation of assets, which is very well specified in the Company Acts in Ireland. It's also well specified in the Securities Acts in Luxembourg. Segregated assets means that each fund has a separate investment policy and a separate guideline. So you create an umbrella, you can have 3 or 4 sub-funds. One sub-fund invests in sustainable energy in Italy, another sub-fund invests in sustainable energy in Asia, another sub-fund invests in infrastructure in Europe, and so forth. There is no overlap of assets, even within the same umbrella structure. So if one fund, for whatever reason, goes belly up or goes down or there's a negative return, those investors in that fund cannot recall money from the other funds, and this is quite important. So you have a complete segregation of assets, a separate accounting procedure for the NAV calculation. Every sub-fund is certified and audited annually. We'll see a little bit more in terms of further details when we go into the Alternative Investment Fund Management Directive. Everything is put more black and white. So they're not single regulations coming out from the central banks. It's actually a harmonized regulation which will apply to all the alternative investment structures. Diversification. Now this is a very specific point regarding Ireland. Now as I mentioned before, it was based on the Company Act in 1990. Now in theory, there are no limits to diversification in a QIF. You'll find in Luxembourg they have a little bit more stringent regulations in terms of diversification. They will give you specific limits. Now they will tell you, for example, that the maximum investment in a Luxembourg SIF is 30%, for example. And therefore you have to maintain that limit. In Ireland, the diversification is general. The directors of the fund have to promote a general diversification of the investment in this fund. What does that mean? There isn't a number there. What they expect you to do is that in a year, 2 years, or 3 years' time, they don't expect you to have one investment in one fund. QIF funds, and especially variable capital funds, cannot be one-shot investments. So you cannot use this for a one-shot. You cannot use this for one investment of a solar plant in Italy. That is not diversifying. You need to have 2 investments, 3 investments, 4 investments. That's the kind of diversification they wish to have in the QIF. That's the kind of diversification they want to have in the SIF. If you go back in your notes, you'll see that one of the structures I talked about in Ireland was a unit trust. Unit trust is different. The unit trust has a very specific regulation, rules and regulations, laws that were created for unit trust. The unit trust instead can be used for a one-shot. With the unit trust, it's basically the same. You set up the same umbrella, the same sub-funds, but there's a trustee agreement between the funds and the investors and the manager, and that trustee serves to protect the interest of the shareholders. There is specifically no risk to diversification. There's no limit to diversification. You use that as one shot. This, however, will change soon. As I mentioned before, we will have the ICAV. The ICAV, the Irish CCAV, will come on board. At the moment, I've seen the initial documentation legally, and they don't mention any more general diversification. So it is my view that in the future we can use the QIF with the variable capital structure to do one-shot investments. So we'll see when that happens. This is quite important because this will diversify and differentiate Ireland from Luxembourg, for example, who doesn't have this possibility with the current structures they have.